Oil and gas makes modern life possible. The energy the world requires today and tomorrow will come from decisions made in the oil field today. Oil and gas will remain the leading source of fuel to power affordable energy that is sustainable for the billions of people that depend on the success of the industry. The oil field is a group of people, companies, technologies, and institutions working towards providing the world with safe, clean, storable, and transportable power. The Oilfield 360 podcast is a 360-degree deep dive into the leaders of the industry, who will provide listeners with a first-hand account of what it takes to build, maintain, and lead the energy business into the future. The Oilfield 360 podcast is brought to you by the following sponsors. United Airlines. As Houston's hometown airline, United has long been the preferred carrier of the energy sector. United for Business offers a range of programs and discounted travel options built for all of your energy, resource, and marine travel needs. Get started at united.com/business. Simmons Energy, a division of Piper Sandler, one of the largest and most experienced energy investment banking firms in the industry, offering M&A advisory, capital markets execution, and investment research. For more information, please visit SimmonsPSC.com. Prang & Associates, the global energy search leader. Prang & Associates is the world's leading executive search firm totally dedicated to the energy industry. Over our 39 years, we have assisted more than 750 management teams and boards in 75 countries and conducted nearly 3,600 engagements. For more information, please visit prang.com. Daniel Energy Partners, in-basin research you can trust. A leading provider of U.S. oilfield research, known for its original boots-on-the-ground research approach, as well as its famous barbecue events. Daniel Energy Partners utilizes both its extensive network of top oilfield professionals and frequent in-basin field tours to provide real-time market intelligence. Visit danielep.com for information. Locked-in Global Energy and Marine, uncommonly different. Locked-in is the world's largest privately owned insurance broker and risk finance advisor. Locked-in's global energy expertise is centered in Houston and represents the largest concentration of energy specialists, clients, in the upstream, midstream, and downstream segments of the oil and gas industry. Visit lockedin.com for more information. Upright Digital. Upright Digital specializes in partnering with your business to maximize marketing efficiencies. We have a deep understanding of people, their needs, motivations, behaviors, as well as the technologies that enable brands in many industries to utilize what is available in a changing digital landscape. Find us online at uprightdigital.com.
Welcome to the Oilfield 360 podcast. We are coming to you from Houston, Texas in the Flecha Azul podcast studio. I am one of the hosts, Josh Lowry. I am joined, as usual, with the co-host extraordinaire, Mr. David DeRode.
Good morning, sir. How are you?
I'm good. This is it's about 10 a.m. on a Friday.
Yeah.
Is 10 a.m. on a Friday, is that your best hour of the week? How do you feel at 10 a.m. on a Friday?
Normally it is, but I've been traveling some this week. And
where'd you go?
In Midland and Tulsa and all over town, it seems. So been staying pretty busy.
It was a short week too.
Short week.
We had Monday off, Labor Day. That's when kind of timing. We came back from. I went to the Colonial golf tournament last weekend up in Fort Worth, which was just awesome. And so it's been not only a short week, but it's been. I was having trouble finding some words earlier, so it's been a long week. But no, it's Friday. I'm excited. Got a nice little weekend planned. So.
You bumped into one of our favorite friends and characters up there at the Colonial, Cody Ortowski, didn't you?
So I had never met Cody. And I knew who he was, but I'd never met him. I can see why you guys are great friends. He's hilarious, got a big personality. I told him a couple stories about, the podcast and asked him to come on. He said he wasn't going to come on. I said, well, just give me 10 minutes. I'll have David call you and you'll be on the show shortly here. Yeah. But he was great. So, the podcast is blowing up as we talk about all the time. I'm ready for this. We've got a fun day planned here. Trying to think what else is going on that matters in the world.
We've got a new team built around the podcast, which I'm really excited about. We're both excited about, I think.
You're right. In fact, David, and Jonathan is still he's a friend of the program. He's going to help us out for sure. But we have full-time people now that are going to be doing video and audio. So hopefully you can check us out. Great segue, David. You can check us out on our YouTube channel, and you're going to see a lot more videos that are going to be edited, and we're going to see some short clips that we are going to be doing in-house now, which is something that we haven't been able to do, or haven't done, I should say, in the time that we've had the show. So no, the show is growing.
When you just mentioned YouTube video, Neil's probably saying, "I'm glad I didn't show up in my Motley Crue T-shirt this morning."
Well, before you introduce Neil on this, and we've teased his name here, so just the audience needs to get ready. Victoria Beard is in the house today.
Yes.
She wanted to come see the special guest, and I am wearing a Masters polo and jeans and some casual summer shoes, and she says, "Well, hey, thanks for dressing up."
Yeah.
Very derogatory in how I look, and I said, Victoria, I said, COVID has been a real issue for me. Like, I can't get back into my suits from 15, 18 months ago. So everybody thinks I'm dressing down. I'm really just wearing a leisure suit. This is as close as I can get to business attire without going to work out. And I'm just not going to work out yet.
Yeah.
So
we've got some new chairs in the studio. Not that our old chairs were bad, but they were a little bit lower to the ground. I liked them, but we had some of our guests thought it was a little too low, but the group has done a great job in kind of repositioning thing. We've got a new chair orientation this morning. Done a lot of really cool things around here, but they have not done anything about Josh's socks and shoelaces yet. I mean, it's
Neil, introduce our guest here, before I have to go defend how great I look again.
Yeah. So, ladies and gentlemen, we have the one and only Neil Wizel, who's a great guy, good friend. He's a managing director at First Reserve and on the investment committee there. And glad to have him here. Neil's been in and around the oil field for a number of years, and certainly plays in the infrastructure and industrial services space as well. And, First Reserve's done a lot of stuff over the years, and you've been a large part of that. So we're happy to have you on the show and share a little bit about yourself and what you guys have done and what you're doing.
Well, thank you, guys. It's great to be here. Just another boring Friday in a tequila-branded podcast studio. So I spend every Friday morning like this.
It's
Yeah.
Well, listen, we appreciate the struggle you go through. So one of the questions we ask our guests is, have you ever been on a podcast before?
So I have not a podcast, no.
I've
done some radio interviews. And other media related interviews, but never a podcast.
Well, you will find out that this is the best podcast that you'll ever go on.
I know it is. I know it is already.
Yes.
Yeah.
So, welcome to the show.
I appreciate it.
So this was a fun bit of research that we did on you. David knows you well, and David, the reason when we were doing some pre-show warm-up, you said, "Man, you guys have had some great guests." David DeRode, ladies and gentlemen, the guy is he knows everybody. But so it's kind of fun for me to meet and learn about some of his friends that come on the show. There is a lot in your history. You've done a lot. You've had a great career thus far.
Thank you.
Do you mind kind of catching us up from where you want to start? I mean, you started second grade for all we care.
Sure.
But just how did you get to where you are today?
Right. Well, as you all know, I live in Houston. I know it doesn't sound like it. I grew up in a town on Long Island outside of New York City. Met a native Houstonian in college. Jennifer and I later got married while we were living in New York City. The deal was we were going to live in New York City for the rest of our lives. I had entered finance, and this finance capital of the world. And then after 8 years in the city, we had twins, and it didn't take too long before it was clear we were moving back to Houston, where her family was, and. She was reluctant to raise kids in New York City, and I got all that. And I'd been coming to Houston, spending time with her family for years, and loved the city, so was happy to do it. And that was about 15 years ago. And I joined First Reserve at the same time when I moved to Texas. And so
06. I just want to
07.
Okay.
Coming up on 15 years.
Okay.
Yeah.
So. Not a bad time to leave New York, by the way. 2007 was probably a tricky time to be up there.
Yep, it was. It was great time to come to Houston for a lot of reasons. With what was going on with energy and what was going on at First Reserve and the growth that the firm was having and having a young family. There's few places in my view that are better to raise a family than in Texas, and so it all was a great situation.
Okay. So you get to Houston, 07, come
Yep.
to First Reserve,
Yep.
and your focus is, do you know what your focus is going to be at that point, or
Yeah.
do they kind of fall into it?
Yeah, so the firm was wise in that they understood that I knew very little about energy. But at that time, the Houston office was the much smaller of the two main offices, the other being Greenwich. We had an office in London as well. But Greenwich had really been, I would say, the office of scale at that point. And Houston needed to build its capability and really have people that understood how to buy businesses, make investments. And so I had spent 3 years before that at Credit Suisse working with private equity firms, and then I'd spent 5 years at a private equity firm just outside of New York City, focused on specialty manufacturing and value-added services and infrastructure. And so knew how to originate, diligence, negotiate a private equity transaction, but knew very little on it about energy. And the firm said, put it, in the Houston office, living in Texas, he'll get to understand energy pretty quickly. And so it was important for me to be a generalist and in energy, and spend time on E&P, spend time on midstream and downstream businesses, spend time on all the equipment and services businesses that touch energy. And so that's what I did. I spent time across really the energy value chain, and I was fortunate in that I ended up getting staffed on opportunities that were really neat and interesting opportunities in energy, but most importantly had just great management teams that had been around the industry for 30 years and really seasoned, and were willing to take me under their wing and let me learn at their knee the business.
Okay. What was your first deal in Houston?
So the first situation and investment opportunity I was staffed on, a lot of them came really quick. In that first year, I was staffed on a company called Deep Gulf Energy,
Okay.
which was a deep water Gulf of Mexico E&P company founded by 3 gentlemen who had spent time around Mariner Energy, and they were a very seasoned team. We were drilling in the deep water Gulf of Mexico, and we partnered with the team for over 12 years,
Wow.
which is a long tenure in private equity land, and ended up ultimately being a great situation for us. We ended up packaging up the assets after a decade and selling the whole business to Cosmos, public company, and that basically created their Gulf of Mexico division, and the whole Deep Gulf management team is now with Cosmos running that
That's
business.
probably the best 10-year run. I mean,
Yeah.
historically in offshore oil and gas. I mean, you had the most fun ever possible.
It was a great learning experience. As I said, the management team are just incredible, terrific people, and great businessmen and women, and it was a great return for First Reserve investors. So it kind of all worked. So I got, not everything we've done at First Reserve has worked, like any investment firm, but that one was a good one. It was good to be there early.
Mm-hmm. Okay. So that's your first deal. That takes us about 07, 08 time frame.
Correct.
Then the downturn.
Then the
happens.
downturn took hold, and at the firm we're focused both on how to play a cycle, but also how to back the right management team during that cycle. There's horses for courses. Some guys and women are growth guys or gals, and some are more value, and so I had another really neat opportunity to partner with a gentleman named Tom O'Malley, who had really created significant value over 20 years in the refining industry. And so 2008 took hold. Obviously, the refining industry, along with obviously lots of other industries, had some real challenges. And so he was putting together the band, an old management team, to go and go elephant hunting in the refining business.
Good timing.
So we ended up buying 3 refineries at around 10 to 15% of replacement cost. So very much deep value, and built a refining company around it called PBF Energy, which is now public on the New York Stock Exchange, which was a great learning experience, great partnership for us, and again, another very good return for First Reserve's investors.
I'm trying to think, when you said something a second ago about a cycle. So
Yeah.
you're from New York, dealing with. I mean, so you're not unfamiliar with cycles, but I would imagine coming from New York into the Houston oil and gas world, that gave cycles a whole new.
Yeah, there's an acuity to it, right? I mean, there's cycles that people living all over the world experience. I think living in a city like Houston, that is very energy centric, right? Which is in itself a highly cyclical industry. Right. That did bring a new level.
Yeah.
Next level, as they say.
Right. Now, I would think that it would be. I mean, these are incredible cycles, and the ones you walked into were significant. The pivot, I mean, corporately from upstream over to midstream was probably a great reason to be a generalist at that time.
It was, and I joined, and we saw the cycle trending down and trough, and obviously over the years at the firm, right? We saw a significant upcycle into 2014. Mm-hmm. And now obviously we've seen a lot of volatility and challenge since then around the energy space. So in Houston, you get a front row seat to it.
David, I have one more question before you jump in.
No, these are good questions.
Well, so
keep them going.
Well, because I mean, this was when I was with a company at the time that was private equity backed, and really, I grew up in a family business, so private equity just wasn't a thing that was talked about in the late '90s, early 2000s. But it was a huge thing from '06 to really a couple years ago. But I wonder, were there as many opportunities? Because I remember that just the M&A happening was crazy in the upstream, especially offshore or really anything drilling space, manufacturing especially. And we're going to talk about some portfolio companies in a minute.
Yep.
Was it similar? Because when you talk about a generalist, I'm really not a midstream guy. Was it the same type of activity available over there?
No. So it's a good point. So I would say ton of M&A activity in upstream.
Just right for it, right?
Just right for it. It's just a huge sector. It's highly capital intensive. And even though the sector has gone through so much transition, right, in terms of what deep water offshore, shale, et cetera, it's a sector that's been around for quite a long time. So I would say a ton of M&A activity around upstream, a ton around services, right? A good amount around midstream, and I would say very little around downstream, the refining deal I mentioned. Part of why we were able to do that deal was that there were so many people that weren't really able to.
I called that midstream a second ago. I'm sorry, you're right.
But you're right.
Yeah. Sorry.
But your point stands.
Right.
Yeah.
Yeah. No, it was a wild time, and I remember going to the 2011 drilling conference, offshore and land drilling conference. Yeah. It was the wildest 3-day period, not with just activity of people. I mean, just the amount of business activity happening at that time was unbelievable. Companies were getting merged and bought and growth. It was insane.
Well, you had the confluence of technological advancement.
That's right.
Right. Yeah. And capital availability. And I mean, those two things just really allowed the industry to take off.
All right. So I'm going to keep going, Rod. I'm that espresso, I had it 10 minutes before you did. So I'm high activity right now.
Keep going. You're asking good questions.
So I told you, Neil, that you should have had that espresso, and that's not really for your game. That's just so we're all somewhat on the same level. Because
I'm high energy.
Are you?
Regardless of what I've had to drink.
Okay. Well, so I'm loaded up on.
I promise.
Quite a few double espressos, I should say. When you come into the space that you're talking about, a lot of these you talk about management teams.
Yeah.
And have you learned operations? Have you studied that? I mean, is that something that came natural to you, or are you just strictly finance and then identify good people to help you run these things?
Yeah, so we at least at First Reserve, the way we do it, and there's lots of, I think, recipes for success. Our view is we are investors, active board members, and partners to management. So we're not no one on the First Reserve staff, full-time staff, is going to go in and run a business.
Okay.
I think that we have really benefited from our deep network of operating executives that have come onto the boards of our portfolio companies, whether it's a relationship we have on an informal basis, someone we've known for years, or whether it's a First Reserve senior advisor who's not a full-time First Reserve employee, but a retired senior operating executive, who can really mentor a management team and also play a different role than a partner at the firm or a more junior investment professional at the firm can. So I like to think that we've seen a ton of complex operational issues, all sorts of commercial challenges, lots of strategic issues, around capital formation and M&A and things like that. So I think we can add a lot of value as a board member. We really do our work. We don't show up to a board meeting uninformed, and so. But that's the approach we take, is a very active board role, and that's not a once a quarter board meeting. That's as a board member, but the primary shareholder.
Right.
We're talking to management several times a week.
Well, and if you're listening to this, you should go check out their website, and we're going to talk about it in a minute. But
Sure.
There's a list of their portfolio companies on there, and I know a lot of these companies, and I
Right.
know a lot of the senior leaders at these companies, and as I look at them, I'm like, this is a lot of really smart people doing
Yeah.
really smart things, and so it's interesting to say when you talk about, well, we're the lead shareholder, so we show up to the board meetings prepared. I know some of your other people that are on your team specifically, and
Yep.
it really does blow my mind how smart and capable. And I'm not trying to pump you up. I tell this to people all the time. The world at which like a Simmons Energy operates, First Reserve, any of these
Yep.
these big, professional finance companies or investment firms, like it's the special ops of, like, they're super talented in finance, they're super talented in operations. Oh, and they can go to a baseball game and tell you all about the pitcher's ERA, and
Right.
I'm always blown away by the scope of the breadth of knowledge that a lot of these guys have. So it is interesting to hear you say, that we don't show up unprepared.
Yeah.
And I'm sure the management teams, that makes them feel more comfortable as well.
Yeah, I mean, look, one that's our job, right? That's what we're getting. Our investors are paying us to be very, very informed and very, very involved and have a strong point of view. And so we do. So we do a ton of work, obviously, behind the scenes, and a lot of work, in the scene while we're with management. But also, it's that's what management wants. Management wants a value-added partner. If there are management teams that just want capital and don't want that point of view, don't want that partner, we're not going to be the right investor. We're not. So, like I said, we sort of I think about us as sitting there somewhat in the middle. On one end of the spectrum, you have firms that they'll go in and they'll go run the company. They'll terminate a management team or buy an asset without a management team, and they'll go run it. We don't do that. On the other end, there are folks that are just capital and funding, and that's absolutely not us either. We sort of sit there in the middle as someone who is going to do a lot of work and have strong views and express them, and also try to be a valuable partner to the management
not
team.
just
Help them
backseat driving here.
Help them grow their business, whether it's commercial relationships, introductions, or whether it's helping them solve a complex strategic or operational issue. That's what we think we're there for.
Okay.
Yeah. How often do you feel like you've encountered a situation where, after a period of time or in a short amount of time, the conclusion that maybe you don't have the right management team, maybe they're not able to deliver on what ultimately you guys have asked them to do?
We've gotten a lot better at that. In that it happens less often than perhaps it has in the past.
See what we did there?
Yeah.
I peppered you for 20 minutes.
Yeah.
You're great.
Then
Dave is like, now, when do you recognize?
Yeah, exactly. You're talking about all the good stuff. Talk about lessons learned, and there's plenty of lessons that we learned.
Sure.
Right. I think that a key part of our job as an investor is talent assessment and talent development. But you're asking the assessment question. When do you realize you didn't assess correctly,
Sure.
Or your assessment changed? It's very important that we get it right, and so. A big part of our diligence, beyond all the quantitative analysis that you would expect we do, and sort of market-facing opinions and all of that, and sort of what you would think is standard, a big part of our diligence is assessing the management team, the quality of the team, and does the team have the resources to execute on the growth plan that the investment's predicated on, right? There's a lot of, we have seen a lot of investments where it could have quite a good team,
Right.
but this deal and our capital is taking the company to the next level. Does that same team that's gotten it to here have the resources and the talent to take it to from point A to point B?
Right.
And I would say that we have done a lot to make sure we get that right now, in terms of employing like real tools that we use in assessing each key individual on the management team and being very honest about what's positive and what's not, and whatever's not, is it surmountable? Can you mitigate it? And so I think David, we've gotten really good at it. But part of why we've gotten really good at it is we've learned from a lot of tough mistakes.
Well, I think in fairness, though, to everybody, I think it's the ones that make the mistakes that learn from them are the ones that you should focus on. The ones that continue to make the same mistakes, doing the same thing over and over, expecting different results, that's insanity.
Yeah, what they say is the definition of insanity.
Yeah. So I think, one of the reason I asked the question, obviously you're in the private equity space, and it's been particularly focused in a sector where there's mixed emotions. I would say there's some good information, but I think there's also a lot of misinformation, and it kind of goes back to, in my opinion, what really is meaningful. And from my perspective, it seems like historically there was a focus on financial performance, when in reality, somewhat counterintuitive, non-financial performance, I think, is actually more important than anything else, in the sense that that's ultimately what drives the financial performance. And I feel like there's been a disconnect with a lot of folks in terms of where they've spent their time focusing on teams, as opposed to having those tough assessments and being really honest and going, have we really evaluated all of our risks, and are we addressing them the right way? Do we have the right people to do that? And are we actually paying attention to the information we're generating internally about ourselves to better, steer the ship, so to speak?
Yep. Yeah, I think. Sorry, go ahead.
No. I was just going to say, do you with the ESG kind of becoming a bigger issue, I think the Europeans got it wrong. I think the G ultimately drives everything else. But it seems like if I'm an investor and I give somebody $1, at the end of the day, I want to know that I'm going to get my $1 back plus some.
Right.
And if I'm a lender, if I loan you $1, that I'm going to actually get paid back, and I'm not going to see you on the courthouse steps. And if I'm an insurer, I'm only going to insure you for the stuff that is unforeseeable.
Right.
That you couldn't engineer or manage or mitigate out of the business. And it seems like people are starting to wake up to the fact that there are more things you've got to focus on in a business from an investment perspective than just financial performance, which sometimes can be misleading because it's a lagging indicator. I'm gonna shut up, but
I think you're right. I mean, it's really, there's some of those things are intangibles,
right,
and some of them are tangible, even though it may not be financial performance. For example, we acquired a new investment recently with a management team we'd sort of courted for a few years. And so we're still sort of perfecting the financial reporting package and the monthly pack and the board book. And this is a great team. They just hadn't worked with us before. And they passed a comment at a board meeting we had this week, which is how they really like how we start off every meeting, the beginning of the board pack, even before the table of contents, is whether it's 3 pages, 5 pages, or 10 pages, whatever is required, on environmental, health, and safety performance. Okay, so we thank them for the compliment. For us, that's the way it's been for 15 years, because it was that way when I joined the firm, right? And so that is. Now, we do believe companies that operate safely in an environmentally friendly way and kind of have their act together in that area, take care of their employees, and prioritize that as the number one priority, will also just be better companies, right? And there's an institutional quality of that. So it's the right thing to do, for your employees and for your community and the environment, but it also means you have a better and ultimately what should be a more valuable business. I think a lot of people get that. I don't think as many people get that should,
Right.
Which is kind of related to your point.
Yeah, almost. The funny thing, and that I've been pretty vocal on in the ESG concept. When you think about the industry as a whole, the broad energy industry, the concept of HS&E has been around for quite a while. Health, safety, environment, and I think there were companies that actually focused on that and ran their business as a result of the feedback they got from that. Then there's others that did a lot of lip service, but I think that's true in whatever business or even in life. There are going to be people that talk the talk and the ones that walk it, actually. Yep. And then people started focusing on quality a little bit more and how that became, and where I feel like the industry's already there, even though we've not been given credit for it. And of course, one could say that historically the governance has not been there, but if you just stick a G on the front of that, you've essentially got what these guys have been talking about from an ESG perspective. But you got to have the governance, you got to have the board, you got to have the management team, and you got to have a willingness of people to acknowledge that they can continuously improve the business. And why not do that if you're going to build value? And why not do that if it also helps build reputation for the industry and allows you to pound your chest from a PR perspective?
Did you see the article that was out? I think it was last 10 days, and it said oil and gas passed its first test, that prices are up, the opportunity to drill more, the opportunity to do what we've done in the past was there, and we didn't. And they returned, shareholders are happy, like, okay, you're paying attention to us. I thought that was a pretty good article about people.
Yeah, it was. It was. And I think, and I want to react to something you said, David, which is, I can't remember exactly how you said it, but about how the energy industry and how it's been viewed with respect to ESG. And, look, I think that this is maybe more nuanced than how a lot of people think about it, but we really have to bifurcate. We talk about ESG. There is the energy industry and their companies' dedication and focus around ESG. And then there is the, hard fact that a lot of the energy industry is hydrocarbon producing businesses and those around them that have a carbon footprint. Yeah. But if you put the second piece to the side, this industry has been extraordinarily focused, and I would say a leader around safety.
Absolutely.
And around safety standards and health of employees and communities for decades. And I think the industry ought to be very proud of itself and not be shy about making that point, that the industry's been really a leader here and taking it very, very seriously.
Well, to your point, you said I don't know when it started. They've been doing it as long as I showed up.
Yeah.
Or since I showed up. And the fact is I think if you listen to the podcast on a regular basis, that David, almost from episode 1 to now, has not waffled at all on this. The fact is, a lot of these people do this. A lot of these companies do this, and it's not just a lip service. I mean, this is one of his points that he brings up is a lot of people are outdoors people,
right?
Hunter, fish, everything, and of course we want to take care of the environment. And then you mentioned the safety. If you remember those 2012 days with the IEDC and the drilling, the safety numbers were trending in the right direction, big time. So a lot of it comes down to just us telling the story better, which is kind of the reason this podcast.
It is. I mean, I joke because I think this is the case. This is a case in what we're talking about right now where I do think it really is a PR problem. Sometimes people think they have a PR problem, but they have an actual problem. I think this is a PR problem.
Yeah, people don't just think you're a jerk; you're an actual jerk.
Right.
Yeah.
Right.
No, it's true, and I don't think. It's not only a PR problem, but I think it's just an overall education issue, critical thinking around truly what makes modern life as we know it possible, at least here in North America.
I think that's absolutely right.
And
I have a question for who do you think's doing a good job with this? Who do you think's doing we won't make you call anybody out, but I mean, who's doing a great job of telling the story for themselves? Because you see some companies like Total changing their entire name, right?
Right.
Is that the way to do it? I mean, who do you think's doing a good job of telling the story?
I personally think that two examples, I do think that, and obviously this is like I'm talking my own book and it's pretty self-serving, but it's how I feel. I do think that the large institutional private equity firms invested in the energy value chain have done a really good job around this issue that we're talking about. And I think that we have gotten much better over the last few years in showing how we're not a Johnny-come-lately to these issues, and we're not new to emphasizing them and managing them, and we're getting much better at articulating that. And a big constituency that we're focused on articulating it with, and to, is our community of investors, to their credit, the investors in our funds are demanding it. And I think that we can be very proud, not just First Reserve, but others like us, we can be very proud about how we have managed this over a long time before it was popular,
right.
As an area to focus on, number one. And I would say, without mentioning specific names, Josh, but to answer your question, I would also say that I think a lot of the large public oil service companies, they have done they've been leaders around safety, health, environmental, and I'm talking the larger ones. And I think that they've started to do a much better job at marketing how they've been thought leaders and pioneers in a lot of these areas.
Have any of your portfolio companies experienced the push from their customers? It's like, hey, we are doing this. We need you guys to step up and do this as well.
Yeah, so it's interesting. I think we are now of a view, and a lot of our portfolio companies now, we used to be investing mostly in E&P, mostly in oilfield service. And I would say we always though had a heritage of investing in things that weren't that too. It was just a smaller piece of what we did. Infrastructure assets, industrial services and manufacturing businesses, distribution and logistics businesses. We always did that. But it was a smaller piece if you go back 25 years. Over the last decade, all of that's been a much bigger piece. And while we've always been focused on health, safety, and environmental and ESG concerns in all the businesses, what we've seen is that a lot of these companies are actually being driven as an investment theme is around sustainability and ESG concerns. So what I would say is that I think it is important for our companies to be on the right side of ESG issues in terms of how they operate, but really from an investment perspective, what I think is going to create a lot of value for some of these companies is if they can show how they can help their customer base achieve their sustainability and ESG goals. That's a very valuable product in this environment. And I think we're at the beginning of a multi-decade investment cycle around energy transition and ESG focused imperatives. And I think if you can have a business that, whether it's an asset integrity business like a lot of our businesses or some of our businesses that are participating in the circular economy, we can talk about some of them, but if you can demonstrate that you can help these large public companies that are your customers that have made significant commitments around ESG and energy transition, then I think that's going to be a very valuable business. I don't know how many terminal multiples, how many increase in terminal multiple that translates into, but I think a good amount.
But the funny thing is, though, I think when you talk about some of the bigger companies, and I'll name names, the ExxonMobils, the Chevrons, I would say the North American large companies, it's like we're talking about energy transition like it just is something that needed to be talked about last year. They've been transitioning for forever. And again, going back to comments about PR, I just think they've done a terrible job of educating people, because they've I think
they've
we've
been
trained,
alone. They've been alone.
Well, we've trained so many people to think about financial performance alone, and what people don't, I think, have a really good grasp on is that financials are somewhat fungible, and they're also lagging indicators of performance. So they're not really necessarily telling a story of
And the public markets are
sustainability.
very.
They're
Not to
quarter to
interrupt, the
quarter
public markets are
focused.
very short-term focused,
correct.
quarter to quarter focused.
And there's a problem with that, particularly if you've got to do something, I think, that may not look logical in one quarter, but makes a whole hell of a lot of sense for the next 3 years, of an investment in whatever it might be. And it's to me, it's somewhat comical in the sense that you've got all these investors coming in saying, we want you to do this, while it's at the cost of what they're ultimately have invested in this company for.
Right.
And they're not giving it a chance for certain strategies, I think, to play out. And it's to I think the point we were all making earlier, a lot of these companies have been doing a lot of the right things for a long time. It's when I think you get misinformed or different opinions about certain directions they should go without a true focus on sustainability, and it's just focused we just want to see this, and as a result of that, they actually get weaker performance or worse performance than had they allowed teams to do certain things. I know I've had that discussion with a number of different management teams, particularly CEOs, who've expressed frustration sometimes with their boards, where they're against doing something because intuitively it makes sense to them, but counterintuitively, where they were wanting them to cut costs, maybe they should be spending more money in certain things.
Right.
And it's been kind of interesting. And they're good companies that have good grasp of this, but then there are a lot of folks that don't.
Yep.
So, private equity, as you know, has been something that's blossomed over the last 20 years, really, or 30
you're
years.
Actually, I'm jumping on your back here, David. This is the future, by the way. You're the first one to see our TV on live action.
Oh, cool!
I love it. So
cool.
We have the portfolio companies here.
Yep.
We're looking at 25 to 30 companies active. You guys have right now.
Yep, that's about right.
So great companies. I highly recommend anybody listening to go check it out. But the amount of influence where I'm company 1, company 2, company 3, the three of us here. All right, I may like to do it, and I may have a great ESG program, or I may not call it that 10 years ago. But what's one company going to do? All of a sudden, a group like First Reserve comes in with a model of 25 different companies saying, hey, we're all going to do this. This is what we're going to do. And not only are we all going to do it together and simultaneously throughout the industry in different, mid, up. And
Absolutely.
The mouthpiece, though, that you brought up Exxon Chevron a little bit ago, you're right. This isn't new to them, but it's one group. And just like anything, it's going to take, if you will, the soldiers of oilfield services and the smaller E&Ps and the smaller drilling companies to kind of get in there and jump on that. So I just wonder, and I think I know the answer to this, but I'd like to hear, are you guys actively coordinating that mindset through these different?
Totally. I would say, we have, for example, an ESG toolkit that we use in diligence. Same toolkit for every company. So that helps us assess where the company is from an ESG perspective. Are we comfortable with that? And then what do we do to bring it up to First Reserve standards? Okay, so that's sort of one. Then we have a regular reporting tool that all these companies will use. That's an ESG dashboard, right? And so there's a lot that we're doing together, and then we're hosting CEO summits and conferences and regular conversations around best practices around these things, which not just ESG, lots of things.
Yeah.
So we try to have a lot of synergy and sort of sharing of best practices and lessons learned among the portfolio. I will say, and just if we're trying to be balanced, there are haves and have-nots in the sector broadly.
Sure.
Okay, so I think there are lots of businesses that can both operate very safely and responsibly and sort of live a proper ESG mandate in terms of how they're run, and also have an opportunity to participate in the value creation that's coming from the energy transition and the focus on sustainability. There are some companies that, because of perhaps their narrow scope and where they've tended to focus and just who their customer base is, that I think should definitely focus on number one. Every company should. Number one is table stakes, right?
Right.
But doesn't really have a product or an opportunity to participate in that value creation. I mean, I don't know. I think that there are some mid-cap, small-cap oil field services companies that I don't really see the path toward value creation around sustainability. It doesn't mean it can't be a great little business that operates in a safe and sustainable and effective way, and can't be a great service provider to its customer base, which are E&P companies, and can't drive costs out of the business and generate synergy from M&A opportunities. I mean, there's a future there, but I think it would be unrealistic to assume that small cap oilfield services company is going to now suddenly transition into a business that is, really benefiting from energy transition.
No, and they don't. I agree with you. So we just took a first for the show. We've had tequila breaks with Aaron Marquez. We have never had an espresso break. So
No.
we are back. So I'd like the audience's opinion.
And we're back in wide awake.
Yes.
Yeah.
So it's about a 5-minute espresso break. But yeah, so we're going to jump back to it. Go ahead, David.
So, I think one of the things we were interested in chatting about and observation I think a lot of people have been making is that, when you think about the last, 30 years, the emergence of private equity and how it's, in a lot of industry sectors and how it's grown, there's been a lot of frustration, particularly at the energy sector, so-called capital destruction. And I think there's been some capital destruction, but I would say that unfortunately the negativity outweighs the positives, because I know of a lot of companies that have done very, very well, even through the various cycles, not as well as they'd like to, but they are sustainable businesses because they've got really good management practices in place,
Definitely.
good culture, et cetera. And so there's room for improvement, but I know that that's a headwind for a lot of folks in the private equity world, particularly in this sector or around the sector, with certain LPs. Some that obviously lost a lot of capital, some that I think might have done well but are being pressured to do other things. But when I think about where some of that money is now trying to go into alternative energy, renewable energy, which is all good stuff, which, by the way, has been around for a while and has been attempted in a number of ways. I think technology is certainly allowing us to unlock some of that stuff that we didn't get right a while back that allows certain things to go. And while I think some of this capital is going to find a home in some really good companies and opportunities, I think the amount of capital that's going to get destroyed tracing what I call jokingly the green new drug, as opposed to the shale boom or whatever you want to call it, it's going to make the latter look like child's play in terms of capital destruction. What is y'all's view on kind of the world where we are today and the opportunities in front of you guys, and kind of what gets you excited and where you're being cautious and all that good stuff?
No, look, that's a great question. There's a lot in there. I'll make a couple points. One, and again, at the risk again of talking my own book, I will say that I do think that some of the people that are best positioned to be making these investments, right, around energy transition, ESG, and sustainability are firms that at one point were the old energy economy investors, because they've learned the lessons of what you said.
Sure.
And we should be cognizant of that issue around destruction of capital, and sort of what happened at various points in kind of the shale revolution, and so we should take those to heart as we're looking at our investments around sort of this new energy economy. And I think that most of us have learned the lesson, have internalized it, and I think we'll be very reluctant to allow it to be repeated. I think that, and I think that's borne out, right? A lot of us, including First Reserve, have, for example, a SPAC, right, a special purpose acquisition company. In our case, it's First Reserve Sustainable Growth Corporation, which is focused on investing in a sustainability, ESG-driven energy transition business. And we think that we're well positioned to do that because of the opportunities we're seeing in the space and because of the lens that we have, both the traditional energy lens and kind of the new economy energy lens.
Wait, I'm not as smart as David.
Yeah.
I want to understand what you're talking about. So you guys have a new fund. SPACs, I guess SPAC's been around. I feel like they've just exploded in the last 12 months. I mean, am I wrong?
They got the Shack SPAC, which is an indication of of buyer beware. There's definitely the winner. I would say the haves and the have-nots, and
that's really the point. I think there are institutional investment firms like First Reserve and others that have established a SPAC as a means to help find a business that can use a significant amount of capital to meet an aggressive growth plan in this area around sustainability and ESG. And I think that the SPAC is a great tool for folks like us to be able to act on those investments that are more difficult to act on in the context of a traditional private pool of capital. Just given the fact that we're a minority, we end up being a minority, so we don't control the board. Given the sort of nature and shape of what that investment looks like, not appropriate for the fund. There are lots of folks that have in a hot market for SPACs that are not institutions that have just gotten together and created a SPAC, which I think is we're going to narrow the herd at some point over the next, or it's already narrowing, where I think it's the institutional sponsors that are going to be successful in continuing to have SPACs and use them as this tool, and then the less institutional ones may go away.
So I need to put you on the spot just a hair here. We, when this show started out, highly focused on the institutional investor, the private, equity, very finance focused. The show has grown. There's a lot of. I got an email yesterday, David. I meant to tell you about a young guy that just graduated out of school in Mississippi, listens to the show, and was trying to talk about renewables in trucking, and I thought to myself, we are reaching a 22-year-old person right out of college that is asking about renewable trucking questions, and how does that relate to the oil and gas business? So there's a lot of people that aren't the traditional audience that we've had. So do me a favor. I've always told people, and I'm not even going to tell you what, just to make sure. I want to hear what you say first before I say it. A SPAC is I've heard it's a public private equity firm or private equity group.
Yeah, I would say simply what it is a group of investors will create a vehicle that they will take public on a stock exchange. And that group of investors now has this vehicle for a period of time, usually 2 years, to find an investment opportunity, a company that will merge with your SPAC. Your SPAC doesn't have an asset other than cash and trust from the investors that allowed you to create this vehicle. And you will find an interesting opportunity that meets your mandate, that you think will provide compelling returns for public equity investors. And you will merge your SPAC with it such that SPAC then really just becomes that company you merged with as a public company.
Okay.
Right. So you are, and it's neat because you can take companies that are more nascent in their development and have a very attractive and aggressive growth plan, and take them public and get them the capital as part of this transaction that they need to meet that aggressive growth plan. And so we're excited about it because of what it allows us to do. I do want to answer your question, David, on kind of where we're excited and where we're not. And I think that First Reserve is still pursuing opportunities around traditional energy, right? Whether it's an E&P business or something of that nature, we are still in that business in a much smaller way than we used to be. And what I would say is it's much more opportunistic. And one of the biggest reasons is whether it's an E&P company or an oilfield services company, I think it's just very difficult today to assess what the terminal value of that asset will be, right? And so we're having to evaluate those opportunities through a lens of what sort of return can I generate just through free cash flow and distributions of cash over time. And yes, it will be worth something in the end when we go to sell it, but I think it's very hard to know what that multiple is going to be. So for that reason, the bar has just dramatically gone up, right? You can imagine what the filter looks like if all of a sudden you're saying, I'm only going to buy an E&P asset that I believe can generate, whatever return we think's acceptable through free cash flow, and then maybe there's upside through terminal value. So that's why it's become a much smaller piece of what we do, and it's much more opportunistic. I would say that there are lots of what are traditional businesses, so not renewables businesses or I would say particularly green businesses. Lots of traditional businesses where I think you can ascribe terminal value to it. They can participate in sustainability, and that's really where we're very focused. Not in the science projects all the way at the other end of the spectrum that don't have proven revenue or don't have EBITDA, earnings. This is what I'm speaking now. I'm talking about for our traditional business, which is our private equity funds.
Right.
And these are businesses like. We own an industrial cleaning business called DeBusk.
So that's what I was looking at your portfolio companies here. There's a couple I don't recognize on there. This is one of them.
This is one of them. So, DeBusk is a business based here in Houston, founded by a gentleman and some of his partners named Andrew DeBusk, who is a terrific operating executive and entrepreneur, and they're a leading industrial cleaning business. They have some of the largest companies, in the world that contract them to come in and clean complex infrastructure and units inside refineries, chemical facilities, petrochemical facilities, and other industrial assets. And they are, I would say that is a traditional business, right? It doesn't sound very ESG or sustainability like. However, they are helping these huge companies operate more safely, more reliably. And so that's an example of a business. And there's lots of them on that screen that are in different areas that we love.
What's Refuel?
So Refuel, yes.
I just did a big deal.
Yeah, exactly. Thanks for asking about Refuel. I love talking about Refuel. If anyone who knows me knows. Refuel is our convenience store platform. It's a branded convenience store platform that we started in partnership with a few gentlemen that we'd spent a couple years getting to know and courting, where we now own, over the last 24 months, we've established a platform of 113 convenience stores.
Convenience stores. Gas stations, Cokes.
Correct. And the reason why we love it is that the reason why we love it is that if you have a good convenience store in the right location, they are taking significant share from big box retailers, from grocery stores, and from other quick serve restaurants. Mm-hmm. They have a following and a brand, and they're very convenient. And so it's as much a play on that as it is on the distribution and logistics of refined product.
Well, I'm on my computer. What is it? Refuel Market? What?
That's
you guys.
That should be their website. Yeah.
This logo.
Yeah, the hot and crispy. You got the hot and crispy chicken.
I mean, I'm already happy with this. This little discovery.
Travel to Indianola, Mississippi, which is the original home of the hot and crispy chicken, which we've now rolled out across Charleston and across all of our South Carolina locations, and I think you would be hard pressed to find fried chicken that you think
we are going
is
to make
as good as that.
This kid's day. The kid that emailed me yesterday, his name is Noah Blake, and he lives in Mississippi. So Noah, you're getting mentioned.
So
congratulations.
And Noah, the name of the brand we have in Mississippi is Double Quick. It's Double Quick is the C store, and hot and crispy chicken is the chicken breast.
Well, if you knew how much we love a place called Super Chicken here,
Okay.
Which it's offensive how much we love it.
I'm sure it's good. It ain't hot and crispy.
Honestly, I accept that challenge, and I've been known to do a lot of stupid things, and drive for chicken is one of them. So, done. So you guys are into a lot of different stuff.
Yeah, so that's the point. So again, David's, sort of question
Sorry,
around.
I threw us off completely.
No, but this is it. What do you like and what do you not like? Again, we're still investing in E&P assets, but it's a very, very, very strict filter and very high bar. And by the way, we are seeing some neat opportunities that fit that formula. But there's a lot of other services and equipment manufacturing businesses, like Trillium, for example, is one we talked about before. I think David, who runs the company, that is a manufacturer of valves and pumps and other sort of flow control products. That's very much participating in the sustainability tailwind around how you can have industrial assets again operate more safely, more reliably.
But to me, though, when people talk about sustainability, to me, I think sustainability is you have a well-run business, you're aware of your risk, you're actively addressing those risks, you're focused on not only return and margin, but you're also focused on sustainability, meaning you've got a inspired, competent, and accountable and responsible workforce. Because if you don't have that, the widgets you're making or the service you're providing is going to be substandard, and that's going to get in the way of sustainability. And if you also don't have that focus there, you're going to allow waste to happen, which is the environmental issue. And I think most companies that are well run, and the reason why I believe they have such a good story already, they just don't know how to tell it because they've not been trained to tell that, is that if you're focused on all these things, you're not going to have a waste issue. You're going to have you're going to be viewed as a good place to work and a good place to do business with. And to me, when I think of sustainability, that's sustainability. If you're good at what you're doing, you're managing the shop, so to speak, and you're earning a return, you're treating your people well, you got a good product, good service, whatever it is, and you're focused on waste, carbon footprint's going to be optimal or continuously improving. Your people are going to continue to want to give their 110% and want to work for you and do a good job, whatever it is that they're doing. And in theory, provided you're not, blowing all that money on stupid things, the company should be making money and providing return to investors. And so I get a little chuckle every time people say, "Oh yeah, it's a sustainable business." I go, how is investing in something that's way, way far off the spectrum, a science experiment, as you said, going to be a sustainable business if there's no path to, profitability and everything else goes along with it? And then when you think about the stuff that's so-called green, is not as green as people would like it to make it to be. And I think some of the non-green stuff can be quite green if it's managed well. Because I've seen both, right? And
I think that's right. And I think, by the way, you're killing me. You got the fried chicken.
I made him move it.
You got the fried chicken up on the screen, and I'm
I can't wait.
I'm already thinking about lunch.
Yeah.
But no, I think that's right, Dave. And it goes back to the the earlier question you asked around capital destruction, and I do think we're very conscious of it around where we invest, and particularly conscious of it as it relates to the SPAC, which would be something that would be more likely to pursue an earlier stage, more nascent business, right?
Right.
That's not appropriate for the mandate for the private equity fund. And so for the SPAC, that could be very susceptible to that risk. And so we are very focused on, and we told our investors this when we marketed the SPAC, and I think it resonated, which is we are very focused on ultimately investing in a business with a SPAC and combining with a business that is a real business,
right,
that has established revenue, has a blue chip customer base. It may not be, again, and it won't be a business that's generating, today a ton of EBITDA and a ton of free cash flow, just because that's not what this SPAC is for.
Right.
It's for finding a business that has some disruptive process or technology that is going to really help drive elements of the energy transition, kind of ESG imperatives. But again, it's not going to be one of those science experiments. It's going to be a business you're going to look at and you're going to say, okay, I get it. I see how this business is going to generate strong returns for for public equity investors. And it's kind of there's already proof of concept. It's just about how can it accelerate its growth.
Right. The continuous improvement concept.
Correct.
Yeah, it's an old friend of mine told me one time, he said, Jerode, it's real easy getting into a deal. Getting out's a whole different story. And I think
whoever said that was a wise man.
Yeah, and I think the funny thing about some of the successes and the failures, it's running a business, investing in a business. It's a challenging deal, and running a business is super difficult. And I think we've developed a culture over time, and I've said this before, the participation trophy culture, where they feel like, oh, I've made this investment, or I have this company, and therefore I should be successful.
Right.
Without any accountability or sense of entitlement. And they're not challenging themselves, saying, how do we get better? How do we make sure that we are aware of the risks that could jump up and smack us and kill us? And I think with just a little bit of extra attention and awareness and a little bit of thought, not having to spend a lot of money by some of these folks, they would get that. But I think the reality is there's winners and losers. Of course, investors don't like to be told that. And if everybody was hitting a home run, then it'd be a whole different deal.
So can you trade on the SPAC now?
So it's publicly traded.
It is.
It's publicly traded.
What is the symbol?
The ticker is FRSG on NASDAQ.
Okay.
FRSG on NASDAQ,
Okay.
yeah.
Looking that up then. Want to take a look at it if you guys are interested. We're kind of, you got something else?
Well, I was just going to say, kind of tied to all that stuff.
Sorry if I cut you off the espresso.
Which kind of goes.
Not my fault.
Yeah, I know. It happens. Goes to kind of what we like to ask. And I think I would like to ask the question from both a professional and a personal perspective, and that is, you've been around a while, you've invested in a lot of businesses, you've had a lot of successes, you've had your share of challenges like everybody else. Kind of what are some of the bigger lessons learned from those successes, and I don't want to call them failures, but challenging times, both at the first reserve level that y'all carry forward into how we look to continue to improve, and then some personal words of wisdom that we like our guests to talk about. What do you know now that you would have loved to have told Neil Wizel 20 years ago?
Right. Well,
or 10 years ago, or 2 years ago.
We loaded a lot in there.
I was going to say, man,
tell us
how much longer do we have?
Well, we have as much time as you want. The answer to that question.
So I would say, I've been asked the first part of that question a lot. What have you, what is lessons learned, and what have you taken away personally? And I would say, you'll get to First Reserve in a minute, but for me personally, I feel like, you can be confident. And you should be confident if you're good at what you do, but not arrogant. And I know that that's kind of a little bit of motherhood and apple pie, but I think it's too easy. This goes a little bit to your entitlement question,
right?
In some ways, it's too easy to have a couple wins, get a bit more senior. People tell you how thoughtful you are, compliment you all the time. And by the way, I'm not saying this is me.
Did David tell you to tell this to me directly? Because I feel like I feel like you guys had a conversation before you got here, and he said you got to tell John he's out of control.
No,
okay,
of course
then
not.
Good.
Of course not. That's our secret. But it's too. We've seen it with management teams, seen it with peers, seen it with competitors, to get overconfident and arrogant. And I think that this is hard stuff. If it weren't, everybody would do it. And I think that the best laid plans don't always work out. And I think that having a little bit of insecurity and a little bit of always sort of second guessing yourself some in your mind is a healthy thing. I think the day you think that you've figured it all out, you know exactly what to do, there's no more learning. You've learned, you're trained. Now it's just go do. I think the day that you feel that way, you should retire or switch or switch jobs. And so that's just a personal thing I try to do, which is, really not, really try to strike that balance personally.
I think that's good because obviously we mentioned peer group. We could probably, which we won't do, but poke fun at some friends of ours who have done really well and nice guys, smart guys. But did they really move the needle and make something happen?
Right.
And they got and it was successful as a result of strategy and this, that, and the other, or was it a factor of timing? And look, I would rather be lucky than smart any day.
Yeah,
or
totally
good.
agree. Yeah. And even if it was the former, even if they were really smart and they get all the credit, that doesn't mean that they always are going to be.
Right.
And so I think that's just important to remember. And what I would say at First Reserve, what we've learned is, really like a tireless and relentless effort to avoid confirmation bias, and to really drive a culture around debate and challenge and not stifle dissenting voices or opinions. It has to be kind of a rigorous, very, very healthy debate that's full of challenge, and you do things in a respectful way because you want to work with people that are good people and respectful of each other, but you have to encourage and foster that, or you're going to lose something in the conversation. And I think that we just always keep trying to get better at that.
We were talking during our off-air espresso break, and Neil, you have done obviously everything you do post this podcast is downhill. So
obviously,
yes, you've come on.
I'm peaking right now, like right. 11:35 on Friday, June 4th.
This is it.
This is my Pax Romana.
This is it, perfect. But I just feel like you've done a great job of explaining. There's lots of private equity firms. There's great private equity firms, and there's different ones, and they do different things. I feel like you've done an excellent job of just laying the groundwork for what First Reserve is. And I know you're one of the managing directors there, so it's good to hear that you have this much influence amongst your peers, your teammates, et cetera. And then we go back and we look at the portfolio companies, and I know David I'm sure knows more than I do, but I know a handful of CEOs on your list there as well. And you look at this, and the ones that I know are some of the smartest people in the business.
Great group.
And David Parody you mentioned earlier, but if you could do
got his head screwed on
terrific.
Straight.
Yeah, sharp, very strategic guy.
Yeah.
But the TNT crane, a friend of mine, Mike Appling, ran into Mike the other day and was saying how busy they are. They're the busiest crane company in the world right now. Is this what I heard? Something crazy stat like this.
Something like that.
Yeah,
probably not far from it.
Mike's an incredible entrepreneur and businessman, and great friend of the firm, and he's very close to a number of us, and he's built. He and his team have built a great company in TNT, and I'm sure that with everything we're seeing around infrastructure spending and sort of what's coming out of Washington, and also I would say, like, not to be underestimated, the transition that I think Houston's going to go through around capturing what I hope is its unfair share of the energy transition, and sort of the sustainability trend. I mean, I think Houston has its rightful claim to a lot of that, and we need to make sure we capture that. That'll benefit. I'm sort of on a tangent now. I like to talk about that because I really believe in Houston as having a rightful claim to a lot of what's going to happen. But I think Mike's company, TNT, ought to be a beneficiary of it.
Huge. I mean,
huge
infrastructure downstream, and then also the renewable space.
Totally.
I mean, you got to lift a bunch of stuff with them cranes.
Yeah. No, and I did. The numbers, just how busy they were. It's encouraging to hear business is back, and it's exciting that we're moving. And you and David were just talking, but I'm not from Houston either.
Okay.
And I'm not a Houstonian. I've been here almost 20 years. I love it. And what's great about it.
Tell them where you're from, though.
I'm from Dallas.
No. Tell them where you're really from.
Longview?
No.
Hang on. I was born in Longview, raised in Dallas.
But Trophy Club.
Oh, yeah. I say Dallas. I'm actually not. I'm from a town called Trophy Club.
I just love the fact I know several people that are from
nickname?
Trophy Club.
No, that's
that
the
a
name of the
nickname
town,
or-
Trophy
It's the name
Club.
of the town.
That's a real town?
Yes. And all the ladies that I know from Trophy Club are all beautiful ladies.
Well, it's
I
and
mean-
beautiful men as well. It's a
Well,
it's
it's
a-
I'm
stretch
surprised
there.
that anyone born in Trophy Club would ever move from Trophy Club.
I
mean,
this is a
that's
true
just-
story.
It's pretty strong.
I was
you know?
19 years
I'm
old.
from Trophy Club.
Trophy Club, Texas.
I
That's
mean,
what
is
it's called.
there a better icebreaker than that?
Yeah.
Well,
Well, you could be
when I
from
first
Paris,
moved to Houston,
Texas.
there was a gentleman's club called Trophy Club. So I used to wear a shirt that said Trophy Club, and everyone's like, "Why are you wearing that shirt?" I'm like, "What do you mean? This is where I'm from." They said, "Man, that's
sad.
Yeah, you gotta
That's
take-
sad, Josh. You need to take that off.
Yes.
They didn't get it.
They
They didn't
thought
get
it
it.
was a strip club or
well,
something.
it was when I moved to Houston. But it's the reason I moved out of Trophy Club when I was 19 years old. I filed to run for mayor of the town at 19.
Oh, no kidding.
And my mom said, "You got to get out of this town." It's like if you think you can be the mayor at 19, you're too big for
You
this
need to
town.
see the world.
Yeah, you need to get out.
You need to see the
So
world.
That's why I left.
That's a great story, actually.
But I love Trophy Club. Still have a bunch of friends there. But the point too of the Houstonian,
Yep.
is it's a different person.
It is.
It's so civic minded there, and you run into you can mention any restaurant, any gym, anything.
I mean, it is such a great city, and I think so many people that have never lived here will never fully appreciate it. But I mean, you think about this city's business climate, and you think about the civic mindedness and
incredible.
philanthropic just bent to the people that live here. It's a meritocracy. I think you can be from whatever religion, whatever race, whatever background, sexual orientation, whatever.
Yeah.
And you come to the city. If you're a good person, you're willing to work hard, you're thoughtful. There's a great place for you in the city. And look, it's one of the most it's the most diverse city in the United States, and it just has so much going for it. I'm despite some of the challenges right now around traditional energy and what that might mean
It'll change.
for the city's economy. The city has diversified a lot with medical center and other things and higher education. And again, I think that it ought to capture its rightful claim to the benefits that'll come from the energy transition.
Well, we're going to do our part, and it sounds like you guys are too. Before we get going here, you've got a family. You mentioned because of COVID, you've actually been able to enjoy dinner with them.
Yes.
The last
Yes.
12 months. You also mentioned philanthropy.
Yeah.
Are there anything that you're involved in that you want to mention and get a shout out to here?
I'm not involved in enough.
Okay.
I feel I'm
You just made the wrong comment. I can load you up.
I'm on the board and the executive committee of our synagogue congregation.
Okay.
Beth Israel, which is a phenomenal institution. And I'm on the board of Kincaid, our kids'
Great school, yeah.
We've got 4 kids that are attending.
Oh, man.
Twins that are 15, a 12-year-old and a 10-year-old. So we're busy at home.
Yes, you are.
And obviously COVID has been just such a challenge for so many people, financially and health-wise and across a number of dimensions. And I think for some people, one of the things that for some people has been a benefit is more time with family. And if you have young children, that's been a terrific opportunity.
Yeah.
So we're going to give your website then is firstreserve.com.
That's right.
Okay. And then the other, I looked up the SPAC. What was the ticker one more time?
It's FRSG
On the
NASDAQ.
Okay.
And it has its own website.
Yeah, okay, that's exactly right. So if you want some more information about the sustainable fund, growth fund, okay, I like it. Dave, is there anything else that you want to wrap up with here? Any other questions?
No. We skipped over it a little bit, but and maybe you answered it from both personal and professional perspective. But from a First Reserve perspective, if you're talking to your LPs or potential LPs, I mean, what are some of the things that you've learned that you're going to carry forward that material? And if it's catching you off the cuff, certainly understand. But
No, we like this though.
I want to know what is it that you carry forward from some of the lessons learned that you guys actively think about going forward, because y'all have always been fairly thoughtful and
Yep.
to your point, you don't necessarily allow yourself to get in too much of an echo chamber.
Yeah, I think I think one is, and we're always trying to get better at this, but always marrying up the quantitative analysis that you do as an investor, right? The stuff you do at your desk, with like practical experience and points of view from people that are out there day to day, running and working in businesses, right? You have to marry those two things up, and if you're doing that right, it should point to lots of questions that you should resolve as part of making an investment. It should point to questions in the analysis, and it should point to questions in the opinions you're getting from people, and that should hopefully help you narrow your risks, right? So that's one. We have to always get better at that. It's easy to favor one versus another, David, and and you have to try not to. So that's kind of one piece. I would say, a second piece is what I talked about, which is healthy debate. Look, if we'd had, I think sometimes an investment's just not going to go the way you want.
Right.
I think you need to see very few of those. Obviously, being successful, you got to win a lot more than you lose. But what I would say is that I think that, and then sometimes that's just going to happen. But there have definitely been investments where we've had a challenge historically, where if we had properly optimized around a culture of strong debate, encouraged that dissenting voice, et cetera, then I think we probably could have saved ourselves, perhaps not, certainly not all, but a couple of challenged investments. And so I think we've got it right now, where we really sort of celebrate the dissenting voice and really encourage that. And I think that's been super healthy for us, and it'll be helpful in making sure that we, really only make good investments. So I think that's been a big lesson learned, and I think culture is a big piece of it. We've had in the past an occasional kind of transgression into a star culture, and I think that it's been a while since we've had that, and we won't have that again. Meaning, it's the First Reserve brand, it's our investment process, it's our culture that's going to drive good investments, good behavior, good partnership, good returns. It's not one person. And we need to make that's important, because a star culture can really destroy the overall culture and create a lot of challenge. And so those are some examples.
No, I think that's that last the star culture deal, I think, is from a recent experience. I can tell you that hit a nerve there on just thinking about things. To your point earlier, if you're not do I?
I said I think he's definitely looking straight at me on this.
Yeah.
I tend to tell myself how great I am on this podcast often.
No, that was not intended at you, but we. Anyways, I think
you've had personal experience with a situation where you've seen that firsthand.
Yeah, no, I think so, and I think you're absolutely right. If there's too much emphasis there, you can do. It can have overarching effects, damaging effects.
Yeah. I have one more thing. So David took that question into the lessons at First Reserve, but really, we've had you for an hour and a half, right? An hour and 20, somewhere in that neighborhood. You're probably a guy that's difficult to get for an hour and a half.
He is.
I would imagine, which is great. I mean, you're busy and there's lots of things going on. So there's going to be our young friend Noah, I believe his name was, in Mississippi, is not going to get an hour and a half with you. So will be his time with you.
Yeah.
So what we like to tell people is, what is a lesson learned for you personally that you would tell yourself 20 years ago? Is there something that you would give a young guy or a girl today, a piece of advice or a pearl of wisdom that you...
Yeah,
yes.
Definitely. I feel old saying it.
He jumped right on this. I
feel old saying it, but and I think this is like really important for kids today. It was important then. I wish someone had told me it then, but I think it's even more important now with how competitive the world's gotten and kids' schedules is. Like, enjoy what you're doing at that moment. Be productive. I'm not saying, mess around and don't have goals
Right.
and things that drive you and vision, but don't worry so much about how do I get from here to there. If you're doing something that you really love with people that you respect and that are going to treat you well, and you're productive and doing a good job, it'll happen. It'll happen naturally. You don't have to be so focused on how do I get from A to B. And I wish, I spent a lot of my career. I'm not really. I don't think this way anymore, fortunately. But I spent a lot of my career and my time thinking always about, next month, next year, the next thing, and not just really enjoying and soaking up and frankly learning as much as I should have, I think, in that moment. And I hope for my kids that they won't suffer that same issue. And all kids, I hope, will sort of take away that focus more on kind of that moment and not what's next.
I think that's really good advice. Another thing, I just internalize, you run so fast, you're focused on things, and sometimes you don't take the time necessary to really enjoy it. And I think patience truly is a virtue with a lot of folks. They try to force things. I know I've made mistakes trying to force things,
Yep.
and that's good advice.
Well, you nailed it. What do you think?
This is great. Our same time next week?
Yeah,
Absolutely.
yeah.
Well, I'll wrap us up here. David, do you have anything else? We're going to jump to the ending here. When I go into this ending, there's so many things you got to say.
Okay.
It's a thing.
All right.
You got anything else, Mr. D. Road?
No, I'm just anxious to hear what you're going to say
No.
next.
I got to look in the camera, which is always a difficult thing. This is behind the scenes, right?
Okay.
So, Mr. Wizel, thank you for your time today. This is going to wrap up really one of the more enjoyable. I've enjoyed this. This has been great.
It was a lot of fun.
Yes, it's. Thank you for coming on. Thank you for making time.
Thanks for having me.
I passed out all the email addresses. If you have any complaints, send it to David at oilfield360.com. If you thought it was great, send it to Josh at oilfield360.com.
See what I have to deal with.
You can look us up on any of our social media channels. We are on YouTube now, as I mentioned a little bit earlier in the show. So once again, we just thank you for the audience. Thank you for listening. If you have any questions, just give us an email and we'll try to get some questions answered. As our friend Noah asked today, we will definitely respond to those. Thank you, Neil, for your time. David, as always, great show. Appreciate
Good
it.
to see you. Neil, thanks for being
No,
on. It's been
thank
great.
you all for having me. It was awesome to be here. I appreciate
Good luck
it.
to your companies and your people as well.
Thank you very
Yes,
much.
enjoy your summer. Thanks, Ed.